Welcome back to MV Explained. Today the most common attack in all of MV, the sandwich. A whale sends a $2 million swap to a Uniswap pool. A searcher sees it waiting in the mempool, wraps it front and back with 2 trades of their own, and walks away with $67,000, risking almost nothing. We'll build the exact attack on the real Uniswap pool. Watch the whale get shortchanged on camera and then defend against it with one number. Let's go. Here is the whole idea. When you send the swap, it sits in the public mempool for a moment before it's mined, in plain sight. A searcher sees a big one coming and slips their own buy in front of it, paying a higher gas priority so it's ordered first. That nudges the price up. Your swap then executes at the worst price, so you receive fewer tokens than you should have, and immediately after you, the searcher sells what they just bought back into the pool. Your trade inflated. Buy low, let you push it higher, sell high. 3 transactions, 1 block, and the difference comes straight out of your pocket. And this isn't a rare exploit. Sandwiching is the single biggest source of toxic MEV on Ethereum. Billions of dollars quietly extracted from ordinary traders over the years. You don't have to be hacked or sign a malicious transaction, you just have to place a large swap in public without protection. If your trade moves the price and anyone can see it coming, it's a target. So let's see exactly how the money moves. Here's the attack on one screen. Think of the price as a swing. Transaction 1, the front run, the searcher buys WETH first and the price swings up. On transaction 2, the victim, the whale's $2 million buy lands at that raised price, so they get fewer WETH than a fair fill would have given them. That gap is their shortfall. Transaction 3, the back run. The searcher sells the WETH they just bought back into the now inflated pool, and the price swings back down. The searcher ends with more USDC than they started. The whale's shortfall is almost exactly the searcher's profit. Let's build it in Foundry. Instead of mock tokens, we fork Ethereum mainnet at a fixed block. So we're trading against the real Uniswap contracts and the real pool, with real liquidity and a real price. Everything runs locally against that fork, no real victims and no real money. To finish, we start with the skeleton. A test contract that points at the 3 real mainnet addresses, WETH, USDC, and the Uniswap router. 2 players, a searcher and a whale. 2 amounts. The searcher front runs with $1 million. The whale swaps 2, and a set of empty functions. Set up a buy helper, a sell helper, a fair price helper, and the 2 tests. Now we fill them in. First, the plumbing. Setup forks mainnet at block 20 million and hands each player their USDC. The 2 helpers just route a swap through the real Uniswap router. One buys WETH with USDC, the other sells it back. And the clever one, fair whale WETH, it takes a snapshot of the chain, runs the whale's swap alone with nobody in front of them, records what they'd fairly get, then reverts the snapshot as if it never happened. That gives us an honest baseline to measure the theft against. Now the attack itself, 4 lines. We record the whale's fair amount. Then step 1, the searcher front runs with their million, pushing the price up. Step 2, the whale makes their swap and gets back less than fair. Step 3, the searcher sells everything they bought back into the inflated pool. Then 2 checks. The whale got less than fair, and the searcher ended with more USDC than the million they put in. If both hold, the sandwich worked. Read it once more before we run it. We'll put a fair amount first as the reference. Front run, victim, back run in that exact order, which is the whole point. The searcher's transactions bracket the victims. And the 2 assertions encode the harm and the profit in plain English. The whale is worse off, the searcher is better off. Let's run it and see the real numbers. Run it and read the ledger. Line 1, the whale's fair amount, 503 WETH, what they should have received. The searcher front runs, buying 256 WETH with their million. Now the whale swaps, and look, they get only 485 WETH, a shortfall of almost 18 WETH, roughly $68,000, vanished into slippage. The searcher sells their WETH back and gets 1.06 million USDC out, profit $66,889. That's 98% of the whale's shortfall, moved straight into the searcher's wallet. Green means the sandwich worked exactly as designed. So how does the whale protect themselves? One number, a slippage limit. Every swap function takes a minimum out amount, the least you'll accept. Here the whale computes a fair quote and sets the minimum to 0.5% below it. That's the only change. Watch what it does to the attack. Same searcher, same front run, but now when the whale swap tries to execute at the looted price, the pool can no longer deliver their minimum, so the transaction reverts insufficient output amount. The whale simply doesn't trade at a bad price, they fail safely and try again, and the searcher is left holding what they bought high with no victim to sell into. The test passes because the attack now fails. A slippage guard turns a guaranteed loss into, at worst, a retry. Better still, route it privately through something like Flashbots Protect so the searcher never sees it coming, and that's an episode of its own. And this isn't only a local fork. I deployed the same sandwich to Sepolia, a real public testnet, through my Chainstack node and ran it as 3 real transactions live on chain. Here they are on Etherscan. 1, the searcher's front run, $1 million of USDC in, WETH out. 2, in the very next block, the whales swap, 2 million in, and they receive 463 WETH, short of the fair 480. 3, the searcher's back run, selling that WETH straight back for a $67,000 profit. The same attack, the same numbers, now bracketed around a real victim on a public chain where anyone can click in and verify every hop. Quick recap. A sandwich brackets your public swap with a buy in front and a sell behind, and the price you pay in slippage becomes the searcher's profit. Here 98% of it. The first defense is free and you should always use it. Set a real slippage limit, so manipulated price makes your swap revert instead of filling. The stronger defense is to keep your trade out of the public mempool entirely, sending it through a private channel so no one can front run what they can't see. Ordering is power, and Mevi is the business of selling that power. A quick note. Rebuilding this attack safely on real forks and explaining them line by line takes real work. If it helps you, the wallets are on screen and there's a Ko-fi link below. Every tip funds the next breakdown. Thank you. That's the sandwich attack, Mevi's most common play, built on the real Uniswap pool and then defeated with a single number. Next episode, backrunning how a searcher earns risk-free profit right after any big change to a pool without needing a victim at all. Subscribe so you don't miss it, tell me in the comments which MEV topic to break down next, and I'll see you there.